So here we're going to go through the journal entry itself. We said we have to have one debit and one credit. And our total dollar amounts of debits has to match our total dollar amounts of credits. This always has to hold true. This is one of those rules in accounting that there are absolutely no exceptions to. And the other thing is that you can have more than one debit or more than one credit. They don't have to match as far as quantity of them. They just have to match as far as the dollar amount. The other rule I want to point out is that a debit always goes first. All of your debits go first, and they're flush to the left. They're aligned to the left. The common stock is indented to the right. That matches up with the T account where debits are on the left side, credits are on the right side. So this is all the information we'd want. The date, the accounts, the dollar amount, and maybe an explanation of the transaction if needed. So we talked about the T account. It's like a visual representation of the general ledger. In reality, we want more detail than that. We just don't want to see debits and credits. We want to see the date. We want to see maybe an explanation. We do, of course, want to see the debit or credit to that account, and we want a running total. Now, there's a PR here, which we'll talk about. That's the posting reference. So when we get to the point where we're posting a journal entry into the ledger, we pull each piece apart. So this cash is going down to the cash ledger. We're going to enter the date. We're going to enter the amount and make sure to put it, if it's a debit, put it on the debit side. We're going to do a posting reference. Now, what this is it's a cross-reference between the general ledger account and the general journal page in this case. This is also up to the company how they want to use the posting reference. What indicator do they want? Here, this particular company simply uses G for general journal, page 1. So G1, if you're looking at this cash account, you know to go to general journal, page 1 to find the details of this particular entry. That's all it's doing. We'd want to compute the balance. Well, all we have right now is a debit for $30,000, so our balance is $30,000 as well. And we want to put this account number back on the general journal. So this ledger account number, that becomes our posting reference in the general journal. So again, if you're looking at this general journal entry, you know to go to account 101 to find out about this cash. So let's take a look at a few examples for this. Here we have the shareholder investing $30,000 in Fast Forward on December 1st. So looking at our horizontal analysis with the accounting equation, we know that cash increased and then common stock also increased by $30,000. So we're still in balance. The journal entry for this would be debit to cash, because cash is an asset and has a normal debit balance, and we want to increase it with that same normal balance. Common stock is an equity account. It has a normal credit balance, so we want to use the $30,000 on the credit side to increase that. Now posting, we would pull each of those pieces down. So the debit for $30,000 to cash goes down to its T account. The credit for $30,000 to common stock goes to its T account on the credit side. Now I want to point something out here. There are two things. First of all, we talked about the arrows on how to measure or how to determine which account is increased by a debit, which account is decreased. So those arrows should help out. There's also a mnemonic that might help you out here. It's called, well, first of all, you have to remember the 6 classifications of accounts. We know that we have assets. That's one classification. Liabilities is another. And then we have 4 different pieces of equity. Those are the other 4 classifications. Capital or common stock. We have revenue. And then we have expenses. And then we have dividends. So those 6 accounts are the main classifications of accounts. Now what we need to do is figure out which of those have normal debit balances, which have normal credit balances. There is a mnemonic that I've used to learn this. This is how I was originally taught in my first accounting class. First, you understand the 6 classifications. You understand that 3 have normal debit balances, 3 have normal credit balances. And then there's a mnemonic that's called DEAD, D-E-A-D. Your debit accounts, that's the D, are your expenses, E, assets, A, and then dividends, D. So DEAD, your debit accounts include expenses, assets, and dividends. Now the other side is you can either say clerk or Clark. Your credit accounts, C, include liabilities, L, revenue, R, and then C, which is your capital or common stock. So that's one way to memorize those accounts, those normal balances. And again, once you know the normal balance, you know that you need to use that normal balance if you want to increase it, and use the opposite if you want to decrease it. The other thing I want to point out here, cash. This is something that often throws people off, because if you look at your checking account register or your savings account register, this doesn't match up with the rules we're learning here. We said that cash is an asset and it has a normal debit balance. Therefore, if you're debiting it, you're increasing it. If you look at your checking account register or your savings account register, you're going to find the exact opposite. Under your deposits, your increases to your checking account, you're going to see a credit. So if you credit it, you're increasing it, which is the exact opposite of what we just learned. And then on the other hand, the withdrawal, when you're decreasing it, you're debiting it, which is again the exact opposite of what we learned here. The reason for that is that when you're looking at that checking account register, you're not looking at a reflection of your cash account. You're looking at a reflection of the bank's liability account. That's their liability to you. They owe you that money. If you deposit money into that account and you're crediting it on the bank register, that basically means that their liability to you is increasing and they owe you more money. On the other hand, when you withdraw money, you're obviously debiting it on the checking account register. They owe you less money. Their liability has decreased. So that's the other rule to think about there. Let's look at another example here. Fast forward purchases supplies by paying $2,500 cash. So the cash asset is going down. The supplies asset's going up. We're still in balance. The entry would be a debit to supplies to increase that asset and a credit to cash to decrease that asset. Again, to post them, we'd pull them into their respective accounts on the respective side. We have another similar entry. We're increasing equipment by paying $26,000 cash. So cash is going down by $26,000. Equipment is going up by $26,000. The debit to equipment would be to increase it. The credit to cash would be to decrease that. Then again, to post them, you pull them to their respective T accounts. Notice with cash now we've had 3 different entries to it. Here we have another example. Fast forward purchases $7,100 of supplies on credit. So we have an increase to supplies as an asset, and we have an increase to accounts payable as a liability. We're debiting the supplies account to increase that asset. We're crediting the accounts payable to increase that liability. Then if we go down here, we're posting it. So we're pulling the debit down to the supplies. The accounts payable gets a credit. So another example. Fast Forward provides consulting services and immediately collects $4,200 cash. So we're increasing cash for $4,200. We're increasing equity for $4,200. We're still in balance. And by the way, we increased equity by increasing revenue. So here we're debiting cash to increase that asset. We're crediting revenue to increase that revenue account. And again, we pull each piece into its respective T account on the respective side. After all those transactions, we can go forward and prepare a trial balance. We get the running total of each account, debit or credit. The rule here, now that we've pulled everything back together, is that our total debits must match up to our total credits. So on the general journal entry, they matched, they balanced out. When we pulled them apart in any individual account, they're probably not going to balance out. And if they did, it would be a zero balance. To have a balance of an account, you have to have more debits or more credits. So for each individual account, that's fine that they don't balance out. But when we pull all the accounts back together, they'd better balance out. There are 6 steps to go through if they don't balance out. If you find a trial balance that's not balanced, there is an error and you have to correct it before you go on. The good news is that with computerized accounting systems, a lot of this mathematical error, a lot of these issues just simply won't happen. So you won't really need to go through these steps. But it's good to understand this, to understand what's going on behind the scenes. So first of all, if you have an error, verify that the trial balance columns are correctly added. Maybe you just made a mathematical mistake when you calculated the total of the trial balance columns. If that's not the issue, verify that the account balances are correctly entered from the ledger. Did you pull them over properly, or did you maybe transpose some numbers? If that's still not the problem, see whether maybe you pulled them into the wrong side. Maybe the dollar amounts are right, but they're on the wrong side. You put a debit on the credit side or vice versa. If that's still not the problem, you have to take a step back. In step 4, recompute each account balance in the ledger. So it's similar to what we did with 1, only now we're doing it in each account balance in the ledger. You'll have to do it several times until you find your mistake. If that's still not the problem, you have to take a look and make sure you posted the journal entries properly. So, for example, did you pull the right dollar amount over? Did you pull it over to the proper side? And then number 6, your last step, which could take quite a while, verify that each original journal entry has equal debits and credits. One of these steps has to work to balance your trial balance back out. So here we have we start with the beginning balance, and then we go through the beginning balance sheet. We flow through all of our other financial statements: the income statement, statement of retained earnings, statement of cash flows. Those cause changes in our ending balance sheet. In the end, we come up with our financial statements. We have an income statement showing revenues, expenses, and then our net income is the difference. The net income flows over to the statement of retained earnings. So we have the overall balance, add in the net income, subtract the dividends, and we get our ending balance. On the balance sheet, we have all of our assets, all of our liabilities, common stock, and then the retained earnings statement carries the retained earnings balance forward, and we get total liabilities and equity. The ratio that we have for this chapter is the debt ratio, and here we're simply comparing total debt, total liabilities, to total assets. That's all we're doing here. This shows how risky the company is. If they have too many debts, then we're concerned that maybe they're not going to be able to pay off all those debts with the assets that they have. If the assets devalue, if they decrease in value, they may not be able to cover all their debts. So that takes us to the end of this chapter. Hopefully this has helped to flush out the first few steps of the accounting cycle. Thank you for your time, and I look forward to talking to you in the next session.